Let's focus on health savings accounts, or HSAs, a topic frequently tested on the exam. For 2025, you must know the contribution limits. The limit for self-only coverage is $4,300, and for family coverage, it's $8,550. The exam loves to test the catch-up contribution. Taxpayers age 55 or older by the end of the year can contribute an additional $1,000. So, a 58-year-old individual with family coverage could contribute a total of $9,550. A common exam trap involves a married couple. If both spouses are age 55 or older, they can each make a $1,000 catch-up contribution, but they must do so into separate HSA accounts. The exam might present a scenario where they try to put a $2,000 catch-up into a single family plan account. This is incorrect. Eligibility is key. To contribute to an HSA, a taxpayer must be covered under a High-Deductible Health Plan, or HDHP, on the first day of the month. They cannot be enrolled in any part of Medicare, and they cannot be claimed as a dependent on someone else's tax return. The exam will try to trick you here. A question might state a taxpayer has an HDHP, but also has secondary health coverage that is not an HDHP, making them ineligible. Or they might be 66, have an HDHP through an employer, but have automatically been enrolled in Medicare Part A. They are ineligible to make new contributions. For an HDHP in 2025, the plan must have a minimum deductible of $1,650 for self-only coverage or $3,300 for a family. The maximum out-of-pocket expenses are capped at $8,300 for self-only and $16,600 for a family. The core of the HSA's power and a major exam focus is its triple tax advantage. First, contributions are tax-deductible, which reduces the taxpayer's adjusted gross income. Second, the money in the account grows tax-free. Third, withdrawals, or distributions, used for qualified medical expenses are completely tax-free. This makes it a superior savings vehicle compared to other accounts. The exam will test your knowledge of what constitutes a qualified medical expense. This includes most medical, dental, and vision expenses. However, a common trick question involves using HSA funds for health insurance premiums. This is generally not allowed, with 4 key exceptions that you must memorize for the exam: COBRA continuation coverage, long-term care insurance, health coverage while receiving unemployment benefits, and Medicare premiums for those 65 or older. The exam heavily scrutinizes the tax treatment of distributions. If HSA funds are withdrawn for a non-qualified expense, the tax consequences depend on the account holder's age. If they are under age 65, the distribution is included in their gross income and is subject to a steep 20% penalty. The exam loves to test this penalty calculation. For example, if a 40-year-old takes a $2,000 distribution to buy a television, the entire amount is taxable as ordinary income, and they owe an additional $400 penalty. However, if the account holder is age 65 or older, becomes disabled, or dies, the 20% penalty is waived. The distribution for a non-qualified expense is still taxable as ordinary income, but the penalty disappears. This age 65 rule is a critical distinction. A good way to remember the penalty waiver conditions is the phrase, 65, disabled, or dead, the penalty is shed. This simple mnemonic can help you correctly answer a complex penalty question under exam pressure.